Here on Real Conversations, I'm your dedicated advisor for navigating the vibrant and often complex world of property investment right here in Dubai. My goal is to provide you with comprehensive insights spanning real estate trends, cutting edge technology, financial strategies, sustainability initiatives, and the broader economic factors at play. I do this to empower you, my valued clients and listeners, to make truly informed decisions that align with your unique aspirations. So, whether you are on the exciting journey of finding your dream property to settle down with your family, or you are looking to strategically invest and flip for a profit, I understand the challenges and here to help you. If you're tired of sifting through those too good to be true offers that flood social media, I invite you to connect with me directly. I promise to personally guide you, offering a hand holding experience to help you discover the best possible deal that fits your budget and your long term goals. Now, on today's episode, we are tackling a question that's on many people's minds, especially if you are observing the incredible energy and momentum in the UAE's property market. Are we in a real estate bubble? And more specifically, here in Dubai, a city that seems to reinvent its skyline almost daily, is this explosive growth sustainable? Or to put it bluntly, is this a party that is about to end? We are going to explore that compelling question today. But before we dive deep into that, I would humbly request you to hit that subscribe button if you haven't already. Your subscription helps us grow and reach more people like you, and it's an incentive for my production team. And after watching or listening, please take a moment to drop a comment with your thoughts and share this episode with your friends, family, or colleagues who might find it valuable. Trust me, it takes a lot of dedicated effort to research and create these videos, and your support is what truly motivates me to do it more often. All right, let's dive into it. The Dubai's property market, a bubble waiting to burst, or a testament to sustainable growth? Let us explore the realities. So, we have all seen the headlines across major media outlets about the skyrocketing sales, the prices, the never before projects, once in a lifetime offers, and so on. Now, it is of course quite natural for you to wonder if this rocket like ascent has solid fuel or it is running on fumes. I have spent many years as a financial journalist, from my early days in print in Indian Express to the fast paced newsrooms of Bloomberg TV and CNBC. And I have to tell you, I was right there in the CNBC newsroom in 2008. I was a young guy, was quite excited, monitoring the global equity markets, including in the US, and then the opening of the Indian equity markets. From 2006 until mid 2007 was a relatively exciting period, but then the subprime crisis hit the world. I clearly remember watching those screens flash red, the collapse of Lehman Brothers unfolding live, the sheer disbelief all around as the global financial crisis took hold. Trust me, it was a nightmare. That kind of experience, seeing a bubble burst in your face, sticks with you. It makes you look at any market exuberance with a very critical, perhaps even skeptical eye. So, today we are going to do just that. We will break down what a real estate bubble actually is. We'll look at some cautionary tales from around the world, because history, as they say, has a habit of teaching us lessons. We'll touch upon Dubai's past market cycles, and then we will put the current Dubai market under the microscope. Are those classic warning signs flashing, or is there something fundamentally different, something more resilient happening in Dubai? Being a real estate advisor in Dubai, whatever I say could be viewed from the lens of conflict of interest, and that most likely I will not share a balanced perspective. I will try my best to give you a deeper insight which will help you navigate this dynamic Dubai market in a much more confident way. I request you to just stick around and let us dive right into it. So let us start with the basics. What do we mean by a real estate bubble? So imagine a balloon being blown up bigger and bigger. At some point, if it is inflated with too much hot air and not enough material to expand, it is going to pop. In real estate, that hot air is when prices shoot up way beyond what the actual economy can support. To measure that, there are economic indicators like people's wages, job growth, and genuine demand for housing. Now, this is usually the phase when excitement and speculation, the belief that prices will just keep going up, take over from sound economic fundamentals. Usually, this is the start of an economic bubble. Now, to understand better, think of an economic bubble like a party that gets a little too wild. It often starts when something new and exciting appears, maybe a new technology or super low interest rates making borrowing incredibly cheap. This is the displacement phase. Number one, the first phase. Suddenly, everyone wants to get in. As more people jump on the bandwagon, prices start to climb, and that is the boom phase. This is often fueled by a general sense of optimism when the economy is doing well, people have more money and feel good about investing, sometimes without looking too closely at the actual value. Then comes the euphoria, where prices go through the roof and caution is thrown to the wind. This is the phase when everyone around you is convinced that the market just cannot go down. This is the phase when the uninformed investors enter. They buy at extreme valuations, and those with insider knowledge, the early investors and corporate executives that study market cycles, begin to quietly sell. The experienced investors sense the warning signs and the profit taking period kicks in. This is the phase when the late entrants are so convinced that they ignore the warnings of overvaluation and the market reaching the peak. In my experience, I have seen many investors even making fun of advisors and ridiculing them in this phase. Social media influencers play a big role in making investors believe in this frenzy. And this is why who you listen to on social media could make or break your long term investment strategy. So be very careful. Now, usually once the peak is reached, a small event can trigger panic. So it could be a very strong rumor, sudden interest rate hike, or even a regional war. And then the prices can fall as fast as they rose, leaving many with significant losses. Usually the market tries to correct itself, but any signs of stability are negatively impacted by further panic selling. In real estate, sudden spike in distressed deals is one of the signs of panic selling. Okay, so now a few usual suspects often contribute to this. And this is an important one. Please listen to this one. So, first, super low interest rates. When money is cheap to borrow, more people are tempted to buy property, sometimes more than they can truly afford. And that pushes prices up overall in the market. Then there is easy credit. So if banks loosen their lending standards, so remember the subprime mortgages that were a huge part of the 2008 crisis that just pours gasoline on the fire. And a big one, speculation. This is when people buy properties not really to live in them or for long term rental income, but just to sell them quickly for a profit as prices rise. This is also known as flipping property. This creates artificial demand and prices can go completely haywire detached from any real value. Unfortunately, or perhaps fortunately, depending on which side of the table you are, these bubbles always burst. And when they do, it can be messy. The prices crash, people lose their homes, and it can even drag the whole economy down. That day in CNBC newsroom in 2008, watching the meltdown, it was not just the numbers on a screen, it was a prelude to real world pain of tens of millions of families across the world. So, how do we try to spot them before they turn into a potential crisis? The International Monetary Fund, or the IMF as we know, has a checklist that is quite straightforward and useful to look at. It may be a longer video than you might imagine, but then I think it will be very helpful if you can hear me out. So they stress looking at real house prices, which means prices with inflation stripped out. Because otherwise, high inflation can fool you into thinking there is a bubble. So IMF suggests looking at the price to income ratio. Are homes becoming unaffordable for ordinary people relative to their earnings? Then there's the flow of easy credit. If borrowing is too easy and widespread, it can fuel a speculative frenzy. Another key indicator is the price to rent ratio. So I just spoke about price to income ratio, but this is the price to rent ratio. Both are quite useful parameters to look at. So look, if buying is massively more expensive than renting a similar place, it's a warning that prices might be driven by hype rather than the fundamental value of that property. So I heard something pretty interesting recently. Apparently, experts are now even talking about detecting exuberance. You know, that wild, explosive price growth that just feels unsustainable, often because everyone is piling in, chasing those rising prices. So now coming back to our checklist. So after price to income ratio, the easy credit price to rent ratio, comes the next one. And this is important one. Higher number of vacant properties. If there are too many empty properties, it is clearly a bad sign. Please keep these indicators in your back pocket because we will be coming back to them and referring to them. This video is going to be longer than what you are used to watching on social media, but trust me, it will be totally worth it. So please hang on and have some patience and hear me out. Now, history is a great teacher and often a harsh one. The US housing bubble of the 2000s is the one most people remember. Low interest rates after the dot-com bust, a flood of easy money, and those infamous subprime mortgages created a frenzy in the US market. Prices soared, but when the music stopped in 2006 and prices started to fall, it triggered a wave of defaults and foreclosures that snowballed into the 2008 global financial crisis. There's Japan in the late 1980s, an asset bubble of epic proportions fueled by easy credit and wild speculation. At its peak, they said the land under the Imperial Palace in Tokyo was worth more than the entire state of California. When the Bank of Japan finally hit the brakes, the bubble burst and Japan slid into what is famously called as lost decade of economic stagnation. We saw similar stories in Europe as well. So Ireland's Celtic Tiger rode into the late 90s and early 2000s with property prices going through the roof, driven by low interest rates and aggressive lending. In fact, Spain had a massive construction boom. It was building more houses than Germany, France, and UK combined, thanks to cheap Eurozone borrowing. Both countries crashed hard when the 2008 global financial crisis hit, leading to banking crisis and painful recessions. It is interesting to see how these dynamics play out even now. A recent global real estate report from UBS gives us a snapshot. Zurich has seen property prices jump nearly 25% in real terms over 5 years. London, on the other hand, has actually seen property values drop by about a quarter since its 2016 peak. Now, cities like Frankfurt and Munich, which were flagged for high bubble risk in 2022, have seen prices fall by about a fifth since then due to rising mortgage rates. Now, it is important to say Dubai itself had a major market correction around 2008 and 2009. The global crisis was the big trigger, but local factors like a surge in property supply, a good deal of speculation, and easy credit definitely played their part. Prices in some areas in Dubai fell dramatically by 40%, even 60%. It was a tough lesson, but, and this is crucial one, Dubai learned from it. We saw a renewed push for economic diversification, much tighter credit rules from the central bank, and stronger regulations from bodies like RERA, the Real Estate Regulatory Agency. Those lessons are vital for understanding why today's market might just be a different beast. So just hang on with me and I'll explain it further. This brings us to the big question: is Dubai's current property market a bubble waiting to burst? Let's take those warning signs we talked about and see how they stack up against what's happening on the ground here in Dubai as I speak. First, a little history. So Dubai's market has seen its ups and downs. As I said, there was a rapid growth from 2002 to 2008 after freehold laws were introduced. Then came the 2008-2009 downturn, which we just referred, and then there was a recovery from 2011 to 2014, especially after the announcement of Expo 2020, and then a moderation in prices from 2015 to 2019 as the supply increased. Since 2020, despite the pandemic, we have seen an exceptional recovery and a surge in prices. UBS does flag that a high number of off-plan sales, which can be speculative, and new supply could lead to a moderate price correction in the short term. So with that in context, let's dig deeper. So first, let's talk about who is buying and why. And is it all just speculative frenzy? The demand story in Dubai today seems to be driven by some pretty solid, diverse, and real factors. See, people are actually moving here in Dubai. Dubai's population hit 3.79 million recently, with an increase of 134,000 people from January to mid-October last year, and it's expected to pass 4 million by 2026. We are seeing a steady stream of expats, professionals in booming sectors like tech and finance, and a significant number of high net worth individuals choosing Dubai as their home. Last year, in 2024 alone, the report suggests 6,700 millennials relocated to Dubai, the highest influx globally. These are people who need places to live, not just quick flips of property. Then, smart government moves and policies like this golden visa offering long-term residency if you invest over AED 2 million in property have been a huge draw across the world. And then there's the Dubai 2040 Urban Master Plan, a clear vision for how the city will grow sustainably, which gives investors confidence. And don't forget, it's a tax-free environment for property ownership and rental income, and the UAE is ranked number one globally for entrepreneurship. Our strong diversifying economy, Dubai's GDP grew by over 3.1% in the first 9 months of 2024, and the wider UAE economy is projected by the World Bank to grow by 5.1% in 2025. This is not just about oil anymore. Non-oil sectors now make up about 75% of the UAE's GDP. Tourism is booming. Over 21 million international tourists are expected to visit Dubai itself in 2025. Around 70% of Fortune 500 companies have offices in Dubai. This means there'll be jobs, and jobs means demand for housing will go up. A safe bet in a shaky world. Dubai and the UAE have really cemented their reputation as a safe, stable place for people, families, and businesses, especially when other parts of the world feel uncertain. This safety and security are huge draws for people looking at moving out of their respective countries. With all these people moving here in Dubai, the rental demand is high. This leads to a very attractive rental yields, often between 5% to 10%, and some sources also say it go up to 12%. Savills even noted Dubai had the second highest prime rental yield globally at 5% and lead in rental growth in 2024 and will be leading in 2025 as well. This diverse buyer base, from Europeans seeking tax havens to Asians drawn by the location, adds to the market stability. Now, what about the supply of properties? Are we building too much? too fast. Bubbles often go hand in hand with an uncontrolled flood of new properties, and this is something which a lot of people discuss within Dubai and outside Dubai as well. Now, let's talk numbers. The villas are actually in short supply. There is plenty of construction of villas, but it seems more managed this time in Dubai. I'll tell you why. So, only about 19,700 new villas are expected by the end of 2025 this year, which is way less than what the market needs, especially with all the families and wealthy individuals moving in. The number itself looks large when you look at it in isolation, but when you put it in perspective, you feel that the supply is less. This shortage is the key reason behind the villa prices going up continuously since 2023. And here's the interesting part, the delivery of villas might get a bit late, say between 6 to 12 months by several developers, which means that the actual supply, the real availability could come into 2026 and not into 2025 itself. Now, moving on from villa, let's talk about the apartments. So apartments are being built in record breaking numbers in Dubai, but the demand remains strong. The apartments make up most of the new homes that are coming into the market. So about 80% of the 300,000 apartments are projected to deliver between 2025 to 2029. But most of the projects get sold out within weeks of the launch. Some developers do get stuck with unsold inventory, it's a truth, but all the good projects are seeing continued demand and they actually get sold within few weeks of launch. Quality and sustainability do matter now. After COP28 was successfully organized in Dubai in 2023, there's more awareness among buyers and a genuine push for green buildings, LEED certifications, and eco-friendly features by the government and the developers. And this is a clear indicator of a focus on long-term value. Now, let us come to money now. Is credit too easy to get in Dubai? Remember how easy credit fueled past bubbles, so it's an important point to discuss. Now, coming back to 2008 2009, lessons from 2009 have been learned in UAE. The UAE Central Bank and the RERA brought in stricter rules after the last crisis. For example, your mortgage payments generally can't be more than half your gross salary. The increased buyer registration fees and tighter loan to value ratios are also in place to curb the speculation in the market. Another factor which doesn't get discussed often is that there are large number of cash buyers in Dubai. A lot of the deals happening now, especially at the high end, are cash purchases or by people with very deep pockets. This reduces the risk of a purely credit driven speculative bubble. So when I say cash, just to clarify, cash means people ready with liquid money and not going for the mortgage. Then comes the scrutiny on the money sources. The UAE is also tightening up its anti-money laundering rules, especially property deals involving crypto, to make sure the funds are traceable. Now, let's look at those key price metrics we have talked about earlier. Price to income ratio. Now, this tells us if homes are affordable for average earners. While we do not have one single official figure for Dubai like some other countries, the huge influx of high net worth individuals and the skilled professionals with higher salaries is definitely supporting the current market levels. Median property prices per square foot have gone up from 889 dirhams in 2021 to 1560 dirhams in early 2025. And importantly, the Numbeo data shows Dubai's city center apartments at around 2100 dirhams per square foot, which is significantly lower than many other major global cities, suggesting relative affordability on the world stage. UBS also notes Dubai's price to income ratios remain favorable compared to cities like Tokyo, Paris, or Zurich. Now, uh, now let's move to the second ratio, which is price to rent ratio. Now, this compares buying versus renting. So, Readin puts Dubai's ratio at about 15 as of April 2025. A general guideline suggests a ratio of 1 to 15 means it is usually better to buy, while 16 to 20 might mean renting is better. So at 15, Dubai is right on that edge. And here's the kicker: Dubai offers really good rental yields, often between 5 to 8%. UBS notes real rents increased 60% since 2020, keeping yields competitive. High yields usually mean property values are not totally out of whack with what they can earn in rent. Higher rentals mean it's not a typical bubble sign. Now, another important factor which we discussed earlier was on the vacant properties. So, this is a big one. Lot of empty properties usually scream that there is a trouble ahead. But in Dubai, residential vacancy rates are low, averaging around 5.4%. In popular spots like Dubai Marina, JVC, downtown, they are even lower, below 4% as of early 2025. Now, we talk about residential, let's talk about office. So, for prime office space, vacancy is practically zero, around 0.2% in some prime areas, according to JLL, with Savills noting DIFC at 98% occupancy. These are not the numbers you see when a market is flooded with unsold, unwanted properties. It shows strong real demand. So, when you put all these pieces together, demand driven by real people and a strong economy, supply that's actually tight in some key areas, tighter lending rules, and prices that, while up, are still supported by good rental income and a few empty properties, it does not scream classic speculative bubble. Now, the US Global Real Estate Bubble Index of 2024, it was released last year, it actually places Dubai in the moderate risk category. It does not put Dubai into high risk like some other global cities. If it's not a bubble, then what is driving this sustained growth and why does it feel like it has legs? I think it comes down to a few really strong interconnected pillars. Number one is a diversified modern economy. The UAE and Dubai in particular has made a massive strategic shift away from just relying on oil. We are talking about thriving tourism, a booming tech scene, a major financial hub, a global trade and logistics powerhouse. This creates a much more stable and varied economic base, which means more stable job growth. Number two, and you'll agree, is that Dubai is a magnet for global talent and wealth. People want to come here. The economic opportunities, the incredible quality of life, the safety, those attractive visa programs like the Golden Visa, it all adds up. Dubai's population is projected to hit 5.8 million by 2040, according to the Urban Master Plan. Now, that's a lot of people needing homes and services. Henley and partners predict the UAE will see the highest influx of millionaires globally in 2025. Now, number three is there's a clear long term vision in Dubai. The Dubai 2040 Urban Master Plan is not just a fancy brochure, it's a roadmap for sustainable development, world class infrastructure. It prioritizes green spaces, enhancing public transport, and even creating affordable housing solutions. If you've not seen that document, I'll urge you to Google it up and take a look at that. And bodies like RERA are actively working to keep the market stable with regulations designed to prevent excessive speculation. I'll come to the next point, which is about Dubai being a global safe haven and a strong lifestyle appeal. In a world that often feels pretty turbulent, Dubai's reputation for safety, security, and being incredibly well connected makes it a go to place for international money and talent. Now, add to that the exceptional lifestyle from shopping and dining to beaches, uh, top tier schools, and healthcare. Dubai is a compelling package. A lot of people don't discuss about the sustainability and innovation in Dubai. There is a real push for green buildings, eco-friendly developments, and smart technologies. Now, this is not just good for the planet, it attracts a new kind of investor and resident who cares about these things, and it makes the developments themselves more valuable in the long run. And the next important point is that the market itself is growing up pretty quickly. We are all seeing a shift in the from the quick speculative flips, and now people are buying homes to live in it, or for even long term investment that is inherently more stable. The transaction volumes are quite high. The luxury market in particular is seeing extraordinary growth driven by ultra high net worth individuals. And according to the UBS report that we just referred, this segment of ultra HNI is anchored by end user and investor confidence and not just speculation. Now, no market is completely bulletproof, right? A big economic slowdown, wild swings in oil prices, or even more competition from other cities in the region could create challenges. But the underlying strengths of the UAE market, the fundamentals, they seem pretty solid and diverse. And I personally believe that the lessons from 2009 were very well and truly learned by UAE. And this current growth spurt is built on much firmer foundations. Okay, now let's circle back to that big question that we started with. Is Dubai's real estate market actually in a bubble? From where I am sitting and having looked at this from many angles over the years, the evidence strongly suggests that while prices have certainly gone up a lot, what we are seeing today is fundamentally different from a classic, dangerous, speculative bubble. The growth seems to be anchored by a real demand from a growing population, a strong and diversifying economy, smart government planning, and a regulatory system that has learned from the past. Those key signs we look for in a bubble, like crazy price to rent ratios or sky high vacancy rates, they just aren't telling that story here. Instead, we see good rental yields and a healthy appetite for the properties being built. The UAE and Dubai within it, as its most dazzling example, is making a compelling case for a sustainable upward growth. That does not mean you throw caution to the wind. Any investment needs careful thought. You take any asset class and you need to be careful about where you are investing. But the narrative in Dubai seems to be one of managed expansion, intelligent development, and a market that's maturing. I remember that feeling in the CNBC newsroom in 2008, the sense of a system on the brink. What I see in Dubai today feels very different. It feels like growth built with a lot of foresight, an economy with far more resilience. The key will be to keep that vigilance, for regulators to stay sharp, for developers and investors to make smart choices, and to keep focusing on those strong economic and social fundamentals that have brought this market so far. While no one can say with absolute certainty that a bubble is a myth, Dubai's current market strength certainly speaks for itself. That's all the time we have for today on Real Conversations. I hope this discussion has given you some valuable food for thought on real estate bubbles and the incredible dynamism of the UAE market. Please subscribe to my website ritukant.com and feel free to drop a comment on my WhatsApp for any queries on Dubai real estate. I promise to respond promptly. Please join me next time as we continue to explore the trends and stories shaping our world. Thank you so much for listening. See you soon.